All right, guys, this is being recorded. One thing I say at the beginning of all these webinars is watch this again, especially if options are new to you. And if you've been a trader for a while, I'm going to throw some stuff in there that even you will learn from. One thing I say at the beginning of all these is also ask your questions when they come up, because I'd rather tackle those, get everybody clear a concept, because we're going to be building on all these things throughout this webinar. So I want to make sure you guys are up to speed and not trying to get a question answered and missing out on something else down the way. So go ahead and fire away. I'll try and answer those as fast as I can. All right. And we are moving on to option strategies that are more advanced now. These are some of the most advanced option strategies, and it's not in terms of difficulty in learning. I don't want to try and pass this off as a difficult concept, but it is a higher risk strategy. Therefore, it should be used when you have gotten your feet wet with options a little bit before this. I wouldn't want you to necessarily jump into this option strategy straight away, but having said that, it is one of the higher probability strategies. So how can I say you shouldn't be doing something that has super high probabilities? That's kind of hard for me to say, but you know, the rules that be say that this, because it is such a high risk strategy in that it could be unlimited loss, that it needs to be advanced. And I can kind of agree with that as well. So we have it as an advanced option strategy, being that of the Strangle. We did the straddle already. We're moving on a little bit further. You know, the straddle is high risk. This one is one of my favorites, though, to trade, especially when you don't have a real idea as to which direction the market's going to go. All right. Let me get a few things out of the way. My name is Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical market analysis. I've been trading my own money since college with a psychology degree, switched it over to finance after I started trading. And then when I graduated from college, moved to Chicago and started out as one of these runners on the floor. In that time, I've traded everything from stocks, financial futures, commodities, currencies, and options, basically on all of these products and pretty much all market conditions. Let me go over this real quick. This basically says anything I talk about in these webinars should not constitute investment advice or solicitation to buy or sell any of these securities or strategies. To be quite honest, we may be very well talking about some of the stocks that I have in my portfolio. I'm not trying to get you guys limbing off the cliff. It goes back to my feeling about this is I want you guys to learn how to swim. I don't want to swim for you all the time. So if we can teach you this stuff, you guys are out there trading on your own. And some people ask me, why do you do that? Well, because I want better markets. I'm selfish. I want us all to get in there and make tighter markets. It doesn't mean that we all have to think the same way, but I want tighter markets. So it's a little bit selfish if we all get in there and put our trades on, that the markets get tighter. It's better for everybody. How do you quantify if it is a high probability? Look at the deltas. That's part of it. Well, and I'll show you something with this strategy where we can do that as well. We can look at probabilities due to standard deviations and things of that nature. Yes. Sorry, got to do a double here. You can also follow me on Twitter at Wolfman's blog or our parent company at ProTraderStrat for all kinds of fun stuff. And like I mentioned, this is on the short strangle. It's not on long strangle. Long strangle is one of our beginner kind of strategies. This, because it's on the short end and a higher risk strategy, we made this more along the lines of advanced strategy. You know, you're going to need a little bit higher risk tolerance for this these strategies in the advanced classes. All right, our market neutral assumption with this short strangle. This is one of those ones where it's kind of like maybe it's getting stuck in a range, trading sideways, trending sideways across the way. But we expect it to stay there, and we could then capitalize on a market-bound or market, very tight range strategy or underlying trading range. Geez, feel like I got marbles in my mouth or something today. All right, so some of the essentials to success are picking the right environment. With this one, I'm always talking about this, and I'm down to one screen on this, so bear with me when I'm going to kind of pop in and out of this slideshow, because I'm sure you guys don't want to see the slideshow all the time. But what I'm talking about with the picking the right environment, we need high implied volatility percent. So when we're looking at something like the charts on Procter and Gamble, when we're looking at volatility, I'm not necessarily talking about the volatility in regards to this number here. Okay, this number here, 19, is different from all different kinds of stocks. We can look at Procter and Gamble over to Activision. They're basically, 76 versus 78, and that had a 19. This has like a 32, and they're about the same implied volatility percent, but you can see that the implied volatility for Activision is a bit higher than it is for Procter and Gamble at any given time. So that being said, the volatility over here isn't what we're looking for. We're looking for where this volatility is in relation to where this underlying volatility has been in the past. And that gives us a good idea if it is high or low for that underlying. Because this number just doesn't really tell me a whole lot other than this is a volatile stock or this is not a volatile stock, right? Activision or even American Airlines might even be considered one of those ones, especially right now. If we look at American Airlines, I think it trades up in the 40s. Yeah, so it's up in around the 40 implied volatility, but as a percent, that is in and around kind of where we were looking at before. It's going to be up in the 60s or 70s. So as a matter of fact, there it is right there. So we're looking at another stock with implied volatility percent in and around those other two, but this one carries on any given day a very high implied volatility for American Airlines. Does that make sense for everybody on that one? All right, good enough. Massive shooting in Annapolis. Sorry, Ted, to hear that. You're in late, but we haven't gotten too far. So you're not too far off. Okay, so that makes sense to everybody, right? The environment. We need a high implied volatility environment for this strategy. When I keep doing this, it's going to keep wanting to mess me up. So I'm going to do the slideshow from the current slide. All right. So picking the right environment. We need high implied volatility environment. We want this for any strategy or for any stock. We want this to be above 50. For any ETF, we want to be selling the strategy when the implied volatility percent for that ETF is above 30. The reason why we do the ETFs a little bit lower on the implied volatility percent is because it's a basket of all these different underlyings, and their volatilities kind of have a tendency to meld each other out. So the spikes aren't nearly as often as you would see with a particular stock, let's say. Okay. All right. All right. So the next one is picking the right underlying. This is really important, you guys, picking the right underlying, because when we're trading stocks, it's pretty easy to find a pretty good market. They're pretty tight. But when we get over into the option aspect, just because it's a popular stock doesn't necessarily mean that those options are that popular as well. So you will see the bid ask on any given underlying get wide in those option montage, okay? And when I talk about the option montage, I'm speaking of where you see those option trades going on. So when we flip over to the trade area, this is the option montage, the calls and the puts, right? We look at just outside the calls for this particular rule. We need this bid to offer from 122 to 126 to be inside of 10 cents wide for any stock under $100. That's my rule. It's got to be 10 cents wide before less than 10 cents wide before I'm going to trade it. American Airlines fits that rule there, right? We could look at something like UPS, where you flip onto it. It's a $100 stock. 10 cents wide. That fits that rule. If it's over $100, my rule is like if it's a $300 stock, move the decimal 3 ticks to the left, and that's how wide the bid ask should be. So a $300 stock should be around 30 cents to the bid ask. And when you're a beginning trader, make sure you stick to that rule, because that gives you a very good idea as to what the value of that stock is when they're tighter markets, right? When they're really wide, 50 cents wide or more, there's not very many people in there trading that stock. So they're not willing to give up very much edge. They have higher risk when there's less participation. So when they have higher risk, they're going to widen their markets. So you have to go to them. You're going to have to give up maybe 25 cents to get in, 25 cents to get out. Well, a lot of times that was your entire profit. So why take that kind of risk when you are limited to the profitability, especially in the beginning? When you start learning how to price options and things of that nature and get better at it, then, of course, you can start making markets and the stocks that you love that weren't previously according to my rules, let's say. All right. So that is picking the right underlying. Picking the right duration is our next step. So we've gone through, we've picked the right underlying, we've got the right environment, high implied volatility for the underlying. And then next, what we're looking to do is go on to the duration. So now we need to figure out, this is the decay. Now we're going to be doing out of the monies. Yes, last week we did at the money, so this chart was like a very good representation. And this is still gives you a good visual, I believe, as to what theta decay looks like the closer we get to expiration. Even the out of the money ones are going to decay in a very similar fashion. I'm not going to try and split hairs on the angle of descent and all of those things. This just gives you a good idea as to when you should be selling options. Inside of 45 to 35 days is a great time to be selling options. We're kind of right there inside of where the slope really starts picking up. I'm still okay with it right here. I would roll out a little further if we had options that were 45 days, but that's another 5 days. If I wanted to put this strategy on now, I would probably go just inside of this theta decay area. So we're going to get a lot of theta decay coming out of those options relatively soon. All right. And then finally, picking the right strikes for the underlying. We're going to be picking that 16 delta. Remember, that is 16 delta tells us one standard deviation to the call side, and a 16 delta on the put tells us one standard deviation to the downside. Okay, so that's where we're going to look to start to set up this strategy. Depending on your assumption, if you thought it was really going to stay tight, you could go a little bit closer to that than that 16 delta. Maybe you go to the 20 delta or something and get that collection. Just know you are decreasing your probabilities of success, because when we look at this bell curve here, standard bell curve, we can see that one standard deviation to the call side. This is kind of representative of the calls, negative being the puts. But the one standard deviation to the call, if we add up all of these percentage of probabilities, we come up to right around 16. Okay, so that being said, we're going to pick the one standard deviation call, the one standard deviation put. And this is a standard bell curve. There are bell curves, especially in options, where these are skewed. They kind of look like they're pushed to one side or the other. They're maybe a little bit tilted. That is what skew is. I'm not going to talk so much about that right now, but we're going to look at the 16 delta. But what I'm talking about with the high implied volatility, when we get high implied volatility happening, what it does is it tells the markets that there's a higher probability of a bigger move. And that bigger move needs to be one standard deviation still. That's what volatility does. Standard deviation is still the same. Like we could say that in this location along this line here, this would be the, let's say, the 100 strike, which is where the underlying is trading. This is the 105 calls, the 110 calls. To the downside, the 95 calls and the 90 calls. Let's just say that's the case. Right now, volatility is trade or implied volatility percent is 50. So that's right in the middle of its road. So that would give us this nice standard deviation curve, right? Well, when volatility increases and we see it get really high and it's up there around the 70s or 80s, this is kind of what happens to that bell curve. It gets squished down. So now this is still the 100 level. And we would say that maybe the 100 calls are right here. And now the 105 calls are the one standard deviation. Okay. And same thing to the downside. The 95 calls might still be here. And these are the 90 calls. And that's where the one standard deviation comes in. So that's part of the importance of having high implied volatility when we're doing these strategies, you guys, is it's not only that it's the 16 delta, right? That's going to always stay the same. But when we get higher volatility and we implement this in a high implied volatility percent environment, it kind of squishes that curve out further. So you're allowed to get further away from where the underlying is trading. Okay. Yes, I will repeat that because that's a newer concept that I just kind of came up with today, to be quite honest. But it is true. So this would be like if we were looking at any given XYZ underlying. And when their implied volatility percent is 50, we can make the assumption that that is right middle of the road, right? Between their high and their low. That would give us a regular looking standard deviation curve. Theoretically, all other things being equal, just to give you an idea as to how volatility works with options. If the underlying is trading at 100 right now, all other things being equal, this being right now could theoretically be the 105 strike on the calls and the 110 strikes at the 2 standard deviation. Now, this is not going to ever really, you're not going to look at the options montage and probably see 105 and 110. All I'm trying to do is get the idea of these just being different strike locations, okay? So 100 and then 95 and the 90 strike, okay? But when implied volatility starts going up, what happens is it squishes this curve out, meaning the range that this underlying could go through now is larger. That's what volatility tells us, is really that the range is now a little bit larger, or could be a little bit larger. And that's kind of what happens with this volatility curve, is it gets squished out. So now right here is that 105 strike and the 110 strike, the 95 strike and the 90 strike. So we would obviously want to implement this strategy when it has high implied volatility, because we're allowed to get further away from where the underlying is for that same amount of premium. We're still going to be getting about that same amount of premium, okay, at the one standard deviation mark. But we're further away. So then when volatility comes back down, and we see it do that a lot, we'll see it on the charts here in a little bit. When volatility comes back down, then it goes back to normal. Therefore, our strikes are way out here, and you can imagine what happened to our premium. All the premium came out. Maybe the underlying didn't move ever, okay? Does that make sense to everybody? Visually, it kind of does that. I understood the just made up. That's true, though. And we'll see. As a matter of fact, I'll show you here in a second. Give me a second. I got a perfect, well, not perfect. It's not going to be perfect, but I got a pretty good one. And knowing your exit strategy before entering the trade. I like to get out of this strategy at about 50% of my max profit. So if I collect $1, I'd like to get out at 50 cents. That's usually my target for this strategy, okay? If you're a newer to this strategy, or you're just getting into selling options to collect a premium, start out with taking 30% profit, and then increase your risk tolerance to like that 50% is what I would suggest over time. But start out maybe around the 30%. Another thing we can look at really is how this all happens, because a lot of times what we'll see when we have really high implied volatility percent and it comes in rather quickly, we can see 25% of our max profit in under 10 days just by volatility coming out. If we're waiting on just theta to come out and we're waiting on that theta decay, it's not going to happen that fast. It's going to take a while for it to happen. But this is when you get that theta decay and the combination of volatility contraction. Because remember, like I said with this strangle or the straddle, is we are selling volatility. We're trying to take advantage of high implied volatility. And when that comes down, our premiums come out, and that's how we profit. And with this one, that's exactly what we're looking for. High implied volatility. We expect the market to settle down. When the market settles down, volatility comes out. We can then profit sooner. And if this is my little chart that you can have, if you're in this strategy for, and you're a newer trader or newer to this strategy, if you're in this strategy for under 10 days and you're already at 25% of your max profit, look to cover it. Under 15 days and at 35% of max profit, look to cover it, okay? Like I said, I'm usually looking to get out of this strategy at around 50%, and that's my target usually. I don't necessarily worry about the days so much, but I will tell you, if I'm in this strategy for less than 20 days and I'm at 45% of my max profit, I am really looking to cover this because I've beaten the odds, all right? Let me see. So let's move on to the next one. All right, and if you're thinking you want to go for like a lot of it, you can stay with this all the way to the 80%. Maybe you want to just stick with this rule kind of thing. I don't have a problem with that. Just know that when I'm doing it and I'm talking about my strategies, I'm getting out at 50%, okay? Guess you would not take this strategy through earnings, even though IV crush, but still risk the price movement of the one standard deviation, Wally's saying. Yes and no, Wally. I have different rules for this strategy in and around earnings, but yes, it is one of my favorite strategies for earnings, but that's all a part of earnings setups, which I'm not really going over right now. Like the timing and everything else is a little bit different for those. But I've got an offer for you. I got a guy. Anyway, max profit. Our max profit is that premium received. Remember, anytime we're collecting a credit as an option seller, that is our max profit. But with that, we have high probabilities. When you're selling option premium, the probabilities are higher than if you are buying it. All right, trust me. And then our max loss is unlimited because of the calls, okay? But we're looking to get out well before that. This is not appropriate for an IRA because it has that short call that is unlimited. I can show you when we pull up the platform how to do that for an IRA. Basically, we're just going to buy the first call input for a nickel. All right. It won't necessarily, if you're on margin for trading options, it's probably not going to limit your margin at all because it's well past where they hold up margin. And then, so our max loss is when that underlying is at a price greater than the call strike plus the net premium. So let's say, for instance, we were talking about those 105 calls, and I collected $1 for the, probably collect $2 for the entire strategy. My break even would be at 102 when the underlying is trading $1.01. That's where, or sorry, $100, $102.01. That's where I start losing money. That's where the loss starts coming in. It's the short strike, which would have been the 100. Sorry, you guys. Short strike is the 105 strike. Our short strike on the puts is the 95 strike. If we collected $1 for each one of those, our total credit would be $2, right? So when the underlying is trading at 107.01, then our loss is started to come into play. All right. So really the easiest thing, and I talked about this last week in the straddle, and I didn't learn for the strangle. Probably should have talked about the break even first, because the break even is a short call plus the net premium. So in this scenario, we're looking at the 105 calls to the upside. We're looking at that to be 107. We add in that $2. That's our break even. Any loss is greater than that. So 107.01 is what I was trying to get out of my mouth earlier. And then on the put side, we were looking at those 95 puts. We subtract that $2 premium. Our break even is then at 93. Our losses start accumulating at 102.99. All right. I hope I didn't lose everybody on that simple concept, but trying to get it out of my mouth. All right. So let me pull up the platform real quick here, if I can, seamlessly, which isn't going to happen. So I have to keep moving some of your questions out of the way. Sorry, guys. It's just how it's going to go today. All right. So what I wanted to show you guys was something about the volatility and the pricing. So we can look at those two that were similarly priced. It was Procter & Gamble was one of them. And Procter & Gamble, we said, had the implied volatility percent in and around that. But this implied volatility for Procter & Gamble is 19. Okay, so that's 19. And then the other one we were looking at for this was Activision, and that's trading around 32. So those are pretty wide differences. Similarly priced underlyings between Procter & Gamble. Can we agree Procter & Gamble is very similarly priced to Activision, 78 versus 76. So again, I have a strategy on in Procter & Gamble. If you've watched the daily market commentaries, clearly not working in my favor right now, but I'm playing the probabilities and the Fibonacci support, or actually, yeah, the Fibonacci support and resistance. Hopefully it's going to act as a resistance. All right, so they both have tight markets. So we can agree that they both have tight markets. Implied volatility percent is very similar to both of these in that. What the option statistics, 57. Let's look at the pricing. If we take this, it's trading right around 78. So we say the at the money is the 78s. Let's just look at dollar to the puts. They're a dollar. They're worth $1. $1 down, $1. $1 up, 78 cents. So that's what I was talking about with that skew. The skew is to the puts, right? There's more volatility punched into the puts. So our bell curve is slightly looking like the leaning Pisa. All right, so the Tower of Pisa. So $1 to the downside, 78 to the upside. Now let's look at Activision, who, as similarly priced, it's going to be $2 more, and that will affect the premium a little bit. But when we go to Activision, trading $76, and we look at $1 lower, it's $1.52. We look at $1 higher, $1.60 something. So you can see the actual skew is actually to the call sides on this, right? $1 higher is worth more than $1 lower. There's skew to the upside. That means there's risk to the upside in a sense, or the market thinks it's going to go up. But that means our bell curve is leaning Tower of Pisa to the other side. When I was talking about how they have those little bit of leans, so the tails are a little bit longer on one side. But that's what we're looking at for that. So that's why we want higher implied volatility. This is implied volatility, all right? And one thing I don't want you to take away from this is like, well, I just got to trade the ones that have the really high implied volatility over here. What's Wolfman talking about the implied volatility percent? Why do I have to worry about that? Well, like I said, all implied volatility percent tells us really is if these premiums are cheap or expensive for this underlying. Right? When it's higher, we know they're more expensive. So we sell them. When it's lower than 50%, we know it's cheap for this underlying. So that's why we buy them. Okay? Does that make sense for everybody with that? Okay, so that's what I was going back to with that volatility idea. With that squishing of the volatility curve, remember? Those further away for that same premium, I could get further away. We could look at these as the 40 delta, right? And then we were using Procter & Gamble. That 40 delta is a lot cheaper. So we can get further away on that underlying, okay? To get to that 16 delta. We're going to get more for our 16 delta too. So in that, it's as easy as we look at our range. So if we were looking at this for Procter & Gamble, for one, I would not want earnings landing in my option cycle, which it looks like this is. So we could look at a couple of different stocks that don't have it. Let's try and look at Devon Energy. And, so one thing I always warn is watching the mainstream media and the talking heads. Now, I love the Nigerian brothers. Don't get me wrong. They're good friends of mine. But they trade options differently than I do. They play more directionality and stuff like that, and that's fine. That's what makes the markets, right? And God bless them, because he's telling people to come in and buy calls in Devon Energy with implied volatility percent super high, which, he's bullish Devon Energy. Said there's a bunch of people buying calls in there. They're unusual option activity or something. I don't know what it is. I think it's going to go sideways. But at the end of the day, he was telling people to buy options. That is the wrong thing to do. Now, he didn't say where he bought his options. He could have bought it with really low implied volatility. I don't know. But he was saying long options here with really high implied volatility. I would say no. This is an opportunity to sell it. So sell premium. So I'm going to look at the charts real quick just to give me an idea where I'm going to be looking at. 45 is obviously going to be a resistance. I'm going to be able to get outside of that. And this 39 area is going to be a support. I could even throw up, if you like to do the Fibonacci, hopefully I got them set up there. I think I do. You can throw up your Fibonacci's and look, okay, or Fibonacci extensions for that matter, if you wanted to get lines up here for resistance. But in that, maybe I think it's going to bounce back and forth in between here, which could very well be true with energy prices being a little bit overdone. I know we got some good inventory numbers or draws on inventories, but I think it's going to be hard to get much higher than this with the economies the way they are. So that being said, that 39 area, it's a little bit low for the pricing on this. Selling the 16 delta here, and then going and selling the 16 delta calls on the other side is how we set this up. Now, it's pretty simple, right? Now, if you were a little bit more neutral in this, you could go a little bit tighter. Maybe the 47 was where the Fibonacci was, and you were like, okay, I think that it's going to hold that area, so you can be a little bit more aggressive. However you add this into your trading regimen, like as a stock trader where, my out would be here as a stop loss or something like that. Well, that's just where your finger hits the mouse to get you out, all right? So play it that way. The other thing I was talking about is if you are doing this in an IRA, basically you go out and buy the first option for a nickel on this. So we would need to increase these a little bit. So I would just go out here and say it's offered at 6 cents. I could probably get that one for a nickel. So that's where I would go in and hold the control button and buy that in to define that risk. Same thing on the put side. Where's my first nickel strategy? It's going to be a little bit further to get to those. So the 34 strike. I just look for the one I can buy for a nickel, and that's where I go. Okay? And that makes it IRA appropriate. Everybody got that? All right. So if you wanted to do this and test it out in your IRA or play around with your IRA, that's how I play my strategies that I want to act like a naked strategy in my IRA. In your IRA, they might hold the margin all the way to there, but in your trading account, most likely they are not going to hold margin that far. It's probably going to be to like the 37 or something like that. So it's not going to decrease your margin or your risk necessarily. It will decrease your risks theoretically, but I would hope you would never allow this underlying to go to that defined risk strategy. We're out well before that, okay? One of the things I talked about with losing, on the losing side of this strategy, we talked about a lot about the winning side of it. On the losing side of this strategy, if the premium increases 3 times, I'm out. So in this strategy, I was collecting 70 some odd cents. When it would increase to $2, that's where I would look to get out. You could do it where it doubles. So if it goes from 70 cents to $1.40, you could be out as well. Obviously, you can add that into the strategy that you use for market direction. If you were using the Ichimuchi cloud, or however you say that, or Fibonacci or whatever. Implement that around this strategy. What is a decent collection amount? John, it really is all going to, it's not that cut and dry, unfortunately, because, you know, when we're looking at those underlyings that have like, you know, a normal implied volatility for that underlying that's around 10 or something like that. It may say it's at implied volatility percent of 100, but that premium you're going to be able to collect for that same $76 stock is probably going to be in the 30s for that 16 delta, versus when we're looking at Activision being up around normally, you know, that 35 area, that collection for Activision for that 16 delta is going to be closer to you know, $1.50 or something. So it's hard to say that, but what we can take away from here is that we know when implied volatility percent is near its highest or at 100%. And when it's at 100% doesn't mean that that's the highest it can go. Because when we're doing the math on implied volatility percent, sorry guys, when we're doing the math on the implied volatility percent, what it does is, because it's an equation, it has its faults. But in the numerator, we take where the current implied volatility is minus the low, so 39 minus this low. 39 minus 26 is 13. So in the numerator, we have 13. We divide 13 by the high, which is 47, minus the low of 26, so 21. So 13 divided by 21 is, I can't do that math right now. 13 divided by 21, I'd have to say it's close to the 60 some odd percent. If somebody can pull that out real quick, I could probably just go back and look. But I would say it's close to 60 some odd just in my head. But I've been known to be way off too. So 61, so not too bad. So that's how you come up with the implied volatility percent. So what we know when it's way up here, even if it went up to say even higher than this, what it's going to say is it's still at 100% because that math comes out. And same thing to the downside. It's going to say it's at 0 even though it's going lower. So it doesn't tell us exactly where the low is and exactly where the high is. But what you can see throughout history is when it gets down that low, it really, just like a stock, it has support and resistance areas where it doesn't like to go outside of very often anyway. So we know that it will, when it's high, want to revert back to the mean. And when it's low, it'll revert back to the mean, okay? When it's kind of right there at the mean, you kind of expect it to kind of slow down and trickle sideways. So that's why I don't mind selling it when it's right at 50, all right? The IV percent is based on 1 year. Yes. And over here on the side, like I have it in my watch list over here on the far right, that's based on 1 year. Now, I do have friends that trade only on implied volatility percent for the past 6 months. Now, if you're going to do that, stay consistent with it and stay with that past 6 months. I like to just do the year on it. I think it gives us a lot of data. My friend is he believes that short term is short term. So, or he's trading short term. So why not look short term? And I can't disagree with that either. Okay. You know, that's two very valid points. But back to what we were talking about with the strategy. And as a matter of fact, Procter Gamble is a pretty good example because I'm losing on it. So let's take a look at Procter & Gamble again and on that losing trade, because if this were a strategy that I implemented, which this is a short put or short call, I'm sorry, and I'm being tested on that short call, right? Now, if I had those puts on this Strangle, they would be way down here, almost worth nothing, all right? It would probably be worth maybe a nickel. There's no reason to have those puts on way down there. All they can do is hurt you, right? You're not going to get much more. You're going to get a nickel, but that doesn't help either. So you might as well either take it off, or what I suggest doing is, as soon as this put would have gotten tested, had I had on the Strangle, like soon as it went, you know, into the money, then you roll those puts up, okay? And I usually try to shoot for about a 40 delta to roll it up and get a collection. You know, if it continues higher and goes into the money, then I'm going to try and roll that put again to make it into the straddle where they are the same strike. I'm going to do everything in my power to not go inverted, meaning where I'm short a 77.5 put, and then I'm short a 78.5 call. That's what I say getting inverted is. Now, if you've collected more than $1 in credit by doing that, then that's okay, because now you've gotten rid of that risk. But I don't want you to lock in a negative number there. All right. Either if you're starting to really worry about it, cover it, get out, and move on. I'm never going to say, if your gut is telling you to get out of a strategy, to stay in it because of the probabilities. I would always say your gut trumps your probability theory. Okay. And I can go into the whole psychology of all that, but I don't have time right now. So roll it to right there at the strike or around a 40 delta is what I'm looking for. Get that collection. The reason why I say the 40 delta, it gives you about $1 wiggle room where you could still collect on both sides of that trade. Does that make sense? So yes, I guess, John, I answered your question before I read it. So John's asked, do you recommend defense rolling of the untested side? Absolutely, I do. And another thing you could do, if you didn't want to go all the way to the straddle, you can, especially if you're inside of, let's say, 20 days. I roll this on the 20 days to expiration to try and get that whole tight strangle. Now I'm about 7 days, and it's kind of pushing the limits a little bit. I still haven't maybe hit my break even on either side, so I'm still pretty comfortable. You can roll this out in time and collect more credit if you still believe in this new market neutral assumption. If your assumption changes, don't roll it out in time. But what I'm saying is, if you still have that same market assumption where it's going to pin right here at 77, I might say that for the market profile, if it was right there on the where the most time and volume is, and I set this up and I was looking at it, I'd be like, hey, this thing's going to get stuck here for a while. That's what usually happens. So I might stick with it a little bit longer. There's all of those things. I'm not trying to, change the way you guys have traded in the past necessarily based on your market assumptions and how you come up with those, but implement these strategies around that, and I think you will do much better. The probabilities are much better. This strategy going all the way to expiration is a 70% probability of success strategy. Okay. That being said, when we get out sooner, those probabilities, and it's only back of the napkin math, but those probabilities spike up into the 80s. So you increase your probabilities of success when you're getting out of these quicker. Okay. I joined the webinar recently, so can you show how to execute the roll on your platform? I can't, because I have to have those. I have to have the strategy up. But I do it in the daily market commentaries. I show that whole roll happening in the daily market commentary, because that's when I'm doing the live, and we're going to be doing live trading coming up pretty soon. So I could do something like that there. But I have to have that strategy in there in order to make it roll. Is the marketplace aligned with any particular Fibonacci numbers or Bollinger Bands? Well, something. I don't know if it probably will in some regards, but Bollinger Bands maybe not. Fibonacci, I do believe they do. And a lot of that has to do with, is it the psychological aspect of the Fibonacci, everybody coming in there at those levels to support and resist, that builds up volume and time around that number. So yes, more so Fibonacci. I wouldn't necessarily say as much Bollinger Bands, but I don't use Bollinger Bands very often anymore. So that's about it for that. There was something else I was going to say with, I don't know. I can't think of what I was going to say in regards to the roll. But that's about it for that. All right. Any other questions real quick before we give On with the show. All right. If you should roll the position, do you keep the same strikes? Yes, I do keep the same strikes when I roll that position. And some, a lot of times if you didn't have to roll to be defensive, I'll just roll it out in time to collect more credit on that strategy too. That's not a problem as well. Like say you got to that 50% of max profit and you're like, well, I want to collect some more. Well, do you go further out in time? Or do you just kind of hold on to it? That's going to be a question for you. I would more likely go out in time to collect more credit, because that would also then give me the opportunity if I wanted to get more defensive. It's a lot harder to be real defensive late in the game with just a few days left, rather than when you have more time, you can get more credit for those rolls and stuff. Does that make sense? Is this a go-to strategy for you? Yes, I use this strategy quite a bit. I love selling strangles. I do like selling straddles, but I probably go short strangle. I do the strangle, short calls, short puts, like iron condors. That's what I love to try and use in and around these. What platform are you using? Toss. I use Thinkorswim. And it's just because that's what I'm comfortable with, and that's what I kind of grew up with. Best for ETF indexes or equities. I like this strategy a lot around ETFs, because when you get that volatility suppression, that I talked about, where they all kind of average each other out, same thing happens with the stock prices and stuff like that, that they all average each other out, and it doesn't seem to be as volatile. Although ETFs have seen that volatility spike right now going on as this quarter's ending, and a lot of hedge funds and stuff are slamming tech and buying stuff like Procter and Gamble, the blue chips and other things like that. So we're seeing that happen right now. I don't know. But anyway, you guys, this is the deal for today. I'll put the link for this in the chat window so you guys can take a look at that over there. You can just click on it. I put it in there now. But this is what we were talking about for earnings, all right? How to trade earnings with options, and I have my specific rules for those strategies, when you put them on, when you take them off, the implied volatility, all that stuff. I go into more detail about what expected moves look like, and that was something that I think Banu asked, and when I'm done here last week, Banu was asking, do I worry about the market maker move when I'm setting up these strategies? And I said no, but I didn't give a very good explanation. So I'll talk about that here in a little bit after I get done with this. But this is a great strategy. It's all of the earnings trades, and we're getting ready to get right back into earnings season. We're a couple of weeks away, so it gives you time to get in there. So for $36, you can't beat it. Like I said, it's over there in the chat window. All we can do really to increase our probabilities of success is setting these strategies up correctly. Yes, you can go online and figure out how to do an iron condor, but they're not going to tell you exactly what strikes to pick, you guys. They're going to just show you, this is what an iron condor looks like on an analyze tab. All right, great. Thanks for nothing. When do I set this up? When should I be doing this? Like my friend Pete, telling people to go out and buying calls in Devon Energy to get the upside. I would tell you, if you wanted that directional move based on what their thinking is, or their market assumption, you should be selling puts. I don't think it's going to do anything, Pete, so I'm going to sell a strangler on it. That's what makes the market beautiful, you guys. And that's why I want you guys to learn how to trade options. We don't all have to trade the same market assumption. But, you guys following this should follow these rules rather closely, because, those guys don't realize the power of it sometimes. And I don't really quite understand why. Can you show the P&L curve for this strategy? Yeah, I'll do that now. So go ahead and do that. You can call us also at 310-598-6677 or email us at trading@protraderstrategies.com. I also just want to thank you guys for participating in this. Later webinars, I'm going to show you how to trade options, trades when and where I find them. I do that every day in the daily market commentaries. Here's also the link. If you're watching this on tape delay, you're going to just have to pause and type this into the URL. Also, you can contact us at 310, like I said, 598-6677, or email us at trading@protraderstrategies.com. All right. So take advantage of that, because I love earnings season. Thank you, John. Appreciate all the kind words. Heather, I did that. Can you show the P&L? All right, so let's try and show the P&L here. All right, where's my platform? Actually, let me do this. What did you want, the profit and loss on it? The profit, you want the Analyze tab on it? Is that what you're asking? I'm not going to be able to pull it up because I don't see where my other platform is. I can't do it right now because it would be, I have to use unfortunately, I have to use, when I show that stuff, I would have to use my I would have to use the other platform so it doesn't show real P&L stuff. That makes sense? Sorry. All right. Sorry, Wally, I can't pull up a real platform. IV percent over 30 for ETFs. Yes, that over 30 for ETFs, over 50 for stocks. I don't see the special offer. It should be in the, so we go back and forth in the windows, or in the window for questions. If you look over there at the big thing, there should be a little window over there, and it says chat. So I pasted that in there. It should be in there. Pro Trader Strategies Options Course. I put it in there again just in case. All right. Great. That's all I got for you guys. Other than, if you can't take that, take it easy. Oh, market mover. Please don't forget. You're right. Good call. I did almost forget. So what we were talking about with this volatility over here. So, you know, if we're looking at this, and just last week we were looking at selling the straddle, right? So we would, in this same regard, collect $1.60 something, right? So knowing just when we're selling high implied volatility and stuff like that, knowing volatility and how it works, excuse me, with each other, you can see that I'm collecting about a $2.70 credit. When you're doing the straddle, it really does come out to generally be very close to where that expected move is for the next 22 days. That's what this is saying. Volatility is saying there's about a $2.86 move, either positive or negative. We generally cover that when doing the straddle, or it's very close to it, so we don't have to worry about it as much. Now, for instance, when I was saying to go out to that delta, right, of the 16 delta for the Strangle, if we're going to be looking at that, I don't know why, what I did there, but if we're going to be looking at doing the, let's say the 16 Strangle, and I go out, hit both of those, then you can see that the $2 and, what is it? What did I say it was? $2.86 move. So that would take us to $80.86 to the upside, right? Well, I'm outside of that doing the Strangle. So that's why this is a higher probability of success than the straddle, but it's albeit slightly, because I can actually get outside of that on it. And I just know that the 16 delta, it's kind of like in geometry, it's the given that the 17 delta is outside of what the expected move is. Does that answer your question then? Okay. I thought about that after you asked that question. I hadn't been asked that question before, and then I thought about it afterwards, and I was like, I should have just done that. So I'm glad you were here to be able to be a part of that too. All right. That's it, guys. Have a great one.